You're 54. The company you've worked at for 12 years announces layoffs. The stock market is down 30%. You open your phone and check your portfolio. Bonds, savings account, life insurance, a house that was worth more last year. Everything your advisor called safe. You look at the numbers. Nobody hacked you. Nobody stole anything. But you've lost money on all of it. Not because you took risks, because safe was never what you thought it meant. There are 8 things that millions of people believe are safe. In a normal year, they feel safe. But in a real crisis, when prices surge, when banks shake, when governments can't pay their bills, every single one of them has broken before. Not a theory, a track record. Before we go through all 8, I want to give you 3 questions. Every asset in this video fails at least one. First, does it lose value while you sleep? Second, can you get your money when you actually need it? Third, does the promise depend on someone you can't control? If the answer to any of these is yes, it is not as safe as you think. 8 assets. For each one, what people believe, what actually happened, and when it's perfectly fine to hold it. This is education, not financial advice. Always talk to a professional before making decisions with your money. Let's go. What most people believe is simple. My money is in the bank. It's earning interest. It's safe. And for most of your life, that feels true. But after World War II, the U.S. government had a mountain of debt. So they kept interest rates low on purpose. Savings accounts paid about 2%. Prices were rising 10 to 20% a year. In a single decade, savers lost almost half of what their money could buy. Nobody took their deposits. The number stayed the same. But what it could buy shrank by almost half. A slow, invisible leak. And nobody warned them. Now, fast forward to 2022, inflation hit 9.1%. Most savings accounts were paying 0.5%. That means for every $100,000 sitting in your savings, you lost about $8,500 in real purchasing power in 1 year. Your bank statement looked fine. Your life got more expensive. Now, a savings account is perfect for an emergency fund. 3 to 6 months of expenses, money you might need tomorrow. The problem starts when people park $100,000 there for 10 years and call it a plan. That's not saving. That's watching your money melt. Here's something you can check right now. Open your bank app, look at the interest rate. Then Google current inflation rate. If inflation is bigger, you're paying your bank to lose your money slowly. But at least your deposits are protected, right? The government insures them up to $250,000. You literally cannot lose. Between 2008 and 2013, 489 banks failed in the United States. And here's the important part. No depositor lost a single insured penny. That's true. But the fund that was supposed to pay them, the FDIC's Deposit Insurance Fund, went negative, minus $20.9 billion by the end of 2009. The fund designed to protect your money was underwater. It only kept paying because the government stepped in behind it. In 2023, it happened again. Silicon Valley Bank collapsed overnight. The government had to invoke a special emergency exception to protect even the deposits above the insurance limit, not because the system worked perfectly, because they were afraid of what would happen if it didn't. Here's the math. The FDIC insures about $10 trillion in deposits. As of the end of 2022, the fund had roughly $128 billion. That's about 1 cent for every dollar it promises to protect. In a normal year, that's plenty. In a real systemic crisis, dozens of banks at once. The only backup is the government creating more money, which brings you right back to inflation. FDIC insurance works. It's been doing its job for 90 years. But it's a promise with limits, delays, and conditions. If you have more than the insured limit at a single bank, that money is unprotected right now. So, savings erode and insurance has limits. What about bonds? U.S. Treasury bonds. The thing every financial advisor on the planet calls the safest investment there is. 2022 was one of the worst years for bonds in recorded history. Long-term U.S. Treasuries, the 20-year ones, lost over 30% of their value. 30%. On the safest investment in the world. Retirees who had moved their money into bonds for safety watched a third of it disappear in 12 months. Warren Buffett warned about this in 2021. He told his shareholders, bonds are not the place to be. Most people didn't listen. Here's how it works. When interest rates go up, the bonds you already own lose value. If the government is selling new bonds that pay 5%, nobody wants your old bond that pays 2%. The price drops. If you sell early, you take the loss. If you hold to maturity, inflation may have eaten your earnings. Either way, you're stuck. And there's a deeper question. You're lending money to a government that, according to the U.S. Treasury, is $39 trillion in debt, and trusting them to pay you back in dollars worth the same as the ones you lent. History says that's not how it usually works. Short-term treasuries, 1 year or less, are a different story. You get your money back quickly, and the price risk is small. Long-term bonds are the danger zone. Okay, individual bonds have risk. What about a bond fund, diversified, managed by professionals, smoother? Here's the thing about bond funds that catches people off guard. A single bond has a maturity date. If you hold it until that date, you get your money back. A bond fund has no maturity date. It's constantly buying and selling bonds inside the fund. So when rates go up, the fund's value drops. And unlike an individual bond, you can't just wait it out. There's no finish line. In 2022, even short-duration bond funds, the ones marketed as conservative and safe, lost real money. 1 to 3 year treasuries dropped about 4%. Many short-duration funds lost 4 to 6%. For a retiree pulling income from that fund, that's not a dip. That's a year of groceries gone. Add up the management fee, inflation, and the price drop. In a bad year, a safe bond fund can quietly lose you 5 to 10% of real purchasing power. The brochure says low risk. Your bank account says something different. Bond funds work when interest rates are stable or falling. The problem is nobody tells you when the environment has changed. By the time you notice, the damage is already done. So at this point, you might think, forget funds, forget bonds, forget all of it. I'll just keep cash. Cash can't crash, right? Cash doesn't crash, that's true, but it melts. Every single day, every single year, it buys a little less than yesterday. $1 in 1971 bought. What about $8 buys today? Your grandfather's paycheck wasn't bigger because he was smarter. It was bigger because nobody had printed his money into the ground yet. Money market funds right now pay around 4 to 5%. Sounds decent. But subtract inflation. Call it 3%. Subtract taxes. You're probably in the 25 to 35% bracket. Your real return is somewhere near 0, maybe 1%. You're running as fast as you can just to stand still. Cash is essential. You need it for emergencies, for short-term expenses, for breathing room. Having 6 months in cash or a money market is smart. Not because it grows, but because it's there when you need it. The mistake is treating cash as a vault. It's not a vault. It's a melting ice cube. Useful today, smaller tomorrow. So savings melt. Insurance has limits. Bonds crash. Funds have no finish line. And cash loses value every day. The question now isn't what's safe. It's what actually survives. I made a full video on the only 6 assets that survived every major crisis in the last century. If you want the other side of this story, the solutions, that video is on screen right now. Cash melts. Banks have limits. Bonds crash. So someone says, what about life insurance? It's guaranteed. The company's been around for 100 years. It's insurance and investment in one. In September 2008, AIG, the largest insurance company in the world, lost $99 billion in a single year and needed over $180 billion in government support to survive. Their insurance subsidiaries technically stayed afloat. But if the government hadn't stepped in, those guarantees would have been worth the paper they were printed on. Here's the connection. The company selling you a guaranteed whole life policy takes your premium and invests it in what? Bonds, real estate, the same assets that crash in a crisis. Your guaranteed return depends entirely on their ability to make money in the same markets that just broke everything else. The average cash value growth in whole life is 1 to 2% after fees. Surrender charges can eat 10 to 15 years of premiums. If you need your money at the wrong time, you might get back 60 or 70 cents on the dollar. The guaranteed part was the insurance company's profit, not yours. Whole life has a place for estate planning, for very specific tax strategies. But as a primary savings plan, the math almost never works in your favor. So at this point, in every conversation about money, someone says the same thing. Just buy a house. It's real. You can touch it. Real estate always goes up. Between 2006 and 2012, home prices in America fell 33% on average. In Las Vegas, Phoenix, parts of Florida, 50 to 60%. Nearly 4 million foreclosures in 2010 alone. People who thought their home was their safety net discovered it was a trap. They couldn't sell, couldn't move, couldn't refinance. And the bills didn't stop. Here's what most people forget. Your home is not liquid. You can't turn it into cash tomorrow. In a crisis, you might not be able to sell for months or at any price close to what you think it's worth. And almost nobody mentions Japan. Real estate peaked in 1989. In parts of Japan, prices took decades to recover, and some segments still haven't. Real estate always goes up is a local story, not a universal law. A home is a great place to live. If it's paid off, it's shelter you own, and that has real value in any crisis. But it's not a liquid investment. It's not a retirement plan unless you sell it. And it's not diversified. It's one asset, in one place, in one market. Last one. And this might surprise you, because this is the asset financial advisors love to recommend for safe, tax-free income. In 2013, Detroit filed for bankruptcy, the largest city bankruptcy in American history. Bondholders, people who had lent the city money expecting safe, steady returns, got back only a fraction of what they were owed. Retirees who held Detroit bonds as their safe income took devastating losses. The city was broke. The bond was just a piece of paper with a promise nobody could keep. Right now, states and cities across America are sitting on trillions in unfunded pension obligations, money they've promised to pay in the future that they don't have. Municipal bonds from financially strained places carry real default risk. The tax advantage is real, but it's meaningless if you lose the principal. Municipal bonds from strong states and cities with high credit ratings can be a solid part of an income plan. The key is knowing the difference between a healthy city and a desperate one. Most people never check. So is everything risky? Is nothing safe? That's the wrong conclusion. The right one is this. Safe depends on how bad things get. In a normal downturn, market drops 20 to 30%, recovers in a year or two. Short-term treasuries work. High-yield savings work. A diversified portfolio works if you can wait. Most safe assets do their job here. This is the crisis your advisor plans for. And most of the time, it's the crisis you get. In a severe crisis, 2008 territory, banks under stress, credit markets freezing, the things that survive are the things that don't depend on someone else keeping their word. Physical gold, land you own outright, essential businesses. This is where paper promises start to bend. And then there's the scenario nobody wants to talk about. Currency crisis, sovereign default. In those moments, only physical assets matter. Gold, silver, productive land, real skills. This has happened. In Germany in 1923, in Argentina in 2001, in Cyprus in 2013, where deposits were frozen overnight. Not ancient history, living memory. The principle is simple. Build your life for a normal downturn, have a plan for a severe crisis, and know that systemic collapse exists because history says it does. Look at everything you own right now, every investment, every account, every policy, and ask yourself, if the worst year of my life starts tomorrow, job loss, market crash, medical emergency, all at once, can I sleep at night holding what I'm holding? If the answer is no, that's not a safe asset. That's a bet you haven't thought through. Remember the 54-year-old from the beginning? He didn't lose his money because he gambled. He lost it because he believed safe meant can't lose. It doesn't. It never did. Every safe asset in history has a breaking point. Safe is not a label you stick on something and forget. It's a relationship between what you hold and what the world is doing around you. In calm times, everything feels safe. In a storm, only things that are real, things you can hold, things that produce something, things that don't depend on someone else's promise, actually protect you. The question isn't, is this safe? The question is, safe against what? And for how long? If this changed how you think about your money, subscribe. And tell me in the comments, which of these 8 did you believe was completely safe? Most honest answers get pinned.